Most investors focus on making money, but the smartest investors know how to keep more of what they earn. One of the best ways to do this is through tax loss harvesting, a legal strategy that reduces your tax bill by offsetting gains with investment losses. But how does it work, and how can you use it effectively? Let's break it down step by step. 1. What is tax loss harvesting? Tax loss harvesting is the process of selling investments at a loss to reduce your taxable income. When you sell a stock, ETF, or cryptocurrency for less than what you paid, you create a capital loss. This loss can be used to offset capital gains from other investments, lowering the amount of taxes you owe. For example, if you made $5,000 in stock market gains but lost $2,000 on another investment, tax loss harvesting allows you to offset the $5,000 gain with the $2,000 loss, meaning you only pay taxes on $3,000 instead of the full amount. If you have no capital gains, you can deduct up to $3,000 per year against ordinary income and carry forward excess losses to future years. 2. Key rules and limits. Before using tax loss harvesting, it is important to understand the IRS rules to ensure compliance. Capital gains offsetting. Losses first offset gains of the same type. Short-term losses apply to short-term gains, taxed at higher rates, and long-term losses apply to long-term gains. Annual deduction limit. You can deduct up to $3,000 per year against ordinary income if your capital losses exceed your capital gains. Carry forward unused losses. If your total losses exceed the deduction limit, the extra losses can be carried forward indefinitely to future years. The wash sale rule. If you sell an investment at a loss and repurchase the same or a substantially identical investment within 30 days before or after the sale, the IRS will disallow the loss for tax purposes. 3. When to use tax loss harvesting. Tax loss harvesting is most effective in the following situations. You have capital gains to offset. If you made profits from stocks, crypto, or other investments, harvesting losses can lower your tax bill. You are in a high tax bracket. The higher your tax rate, the more valuable this strategy becomes. The market is down. If some of your investments are underperforming, this allows you to turn a paper loss into a tax advantage while reallocating funds into better opportunities. The best way to implement tax loss harvesting. Identify underperforming assets. Look for investments that have dropped in value and do not fit your long-term strategy. Sell to realize the loss. Sell enough of the losing investment to generate tax savings, but make sure you do not violate the wash sale rule. Reinvest strategically. Instead of staying out of the market, consider buying a similar investment that does not break the wash sale rule. 4. Tax loss harvesting for crypto investors. Unlike stocks, cryptocurrency is not subject to the wash sale rule under current U.S. tax laws. This means investors can sell their crypto at a loss, realize the tax benefit, and immediately buy it back. However, tax laws change, so it is important to stay updated. 5. Automating tax loss harvesting. Manually tracking losses can be time-consuming, but robo-advisors like Wealthfront and Betterment offer automated tax loss harvesting, helping investors maximize tax benefits without the hassle. Tax loss harvesting is a legal and effective way to reduce your tax bill while keeping your portfolio strong. By understanding the rules, avoiding wash sales, and reinvesting wisely, you can turn market downturns into financial advantages. Are you using tax loss harvesting in your portfolio? Let us know in the comments.